Hello and welcome to the Equity Residences National Webinar. This is Greg, Salley, and John Long, and we're going to walk you through a few slides to give you an overview of our investment funds, and then we're going to open it up for Q&A. Feel free on your keyboard to go ahead and enter any questions you have, and we'll either try to address those along the way, or we'll capture those questions at the end of the presentation. Quickly, just would like to walk through the fine print here. So this is not an offer to sell or solicitation. If you would like more information on either of our investment funds, we're happy to provide a private placement memorandum, and just reach out to us after this webinar and request that additional information. Now I'm going to turn it over to John Long.
Hi everybody. We'll just start about what is Equity Residences. We are a general partnership that manages a family of luxury real estate private equity funds designed for the investment and ownership of a diversified portfolio of vacation properties. Our goal is to provide the most innovative and financially attractive vacation real estate investment vehicles on the market. I'll start off with the team. Greg introduced himself. You've got both John and Greg, the managing directors of the fund. Greg and I founded Equity Residences back in 2012 when we launched the Equity Villa Fund. We've been growing the fund for the last 3 years and recently launched our second fund in our portfolio of funds. Our other member of the general partner is Steve Daring. He's one of the directors of the fund and helped us launch this fund back in 2012. He has extensive experience in luxury real estate, fractional and shared use models, and is a huge contributor to the overall team and our successful model. So let me start with just a simple question of why invest in vacation properties as an asset class? And another question that a lot of you are wondering is, can distressed deals still be sourced in today's marketplace? I'll start with the latter question, and yes, distressed deals can still be sourced. The Equity Villa Fund's last 2 property acquisitions were great investments for the fund and still creating significant value for our investors. And then why are we looking at vacation properties as an asset class? This asset class, vacation properties, they were hit hard during the downturn. And we're frankly seeing deals that are at 10 to 15 year historical lows. We're also able to find properties that you can acquire below construction costs, which really limits the downside risk. We're also looking at premium properties in prime locations. So we're buying at 15-year historical lows, and then at the same time, these are properties that are scarce, limited resources. So they are waterfront, they're ocean view, they're ski in, ski out. So high future value when the market recovers. And then also, with respect to vacation properties, rental income can cover all holding and operating costs. So that's a premise of our fund, is that the portfolio cash flows and creates a sound long-term investment. And then lastly, vacation properties are expected to take longer to bounce back, which is why we're still doing this in 2015, where a lot of the residential real estate markets have recovered. The vacation markets have taken a longer time to bounce back, and we're still out there finding great deals. So what is our business model? It's an innovative and proven investment model for these luxury vacation properties. As I was articulating earlier, we're acquiring a diversified portfolio of vacation properties for as low as 30 cents on the dollar. So rather than our investors buying their own ski house in Lake Tahoe and putting all their eggs in one basket, our investors are putting their money that they may have put towards a second home into a diversified fund where we are now sharing the risk and the long-term upside with respect to properties in Hawaii and Florida and Utah and California and soon international destinations. Secondly, our business model is to cover the operating expenses of the properties from rental income. So we do rent the properties that we own, which then offset all their operating costs. Thirdly, we deliver a lifestyle dividend to investors that enjoy rent-free of our over 65 residences. Or in lieu of vacation destination, free vacations, you can take a rental dividend seeking higher financial returns. Lastly, we sell the properties for a capital gain and distribute the proceeds to investors. We have 2 funds that Equity Residences manages. The Equity Villa Fund is a $22 million fund with a $108,000 subscription price. It's capped at 20 properties at an average property investment of $1 million, with the typical property being 3 to 5 bedrooms. The Equity Platinum Fund, our newest fund in the portfolio, is another 20 property fund at about $2.5 million average property investment, resulting in a $55 million fund of 4 to 6 bedroom properties. So I wanted to walk through an example of an investment in the Equity Villa Fund as to what the economics look like. For starters, it's a one-time upfront investment of $108,000 per unit. With that, you get 2 weeks of annual guaranteed usage in the fund. Now, in addition to that, our investors also have unlimited space available, which we'll talk about later in the model. But for that $108,000 investment, there's 2 weeks of guaranteed usage. Then as a partner in the fund, there are no annual fees, and that's important. We wanted to reiterate that there are no annual fees with respect to the investment and only a nominal visit fee per trip that depends on the size of the property or the location. It's around $250 to $650 per trip. And then you receive $10,000 to $15,000 of vacation value if you use your 2 weeks of guaranteed vacation usage. That's a 9 to 14% annual return that's just on the vacation value itself. All the while, your upfront investment is also working for you and creating value long term. Because in 10 years upon liquidation, you're going to receive that investment back in our projection of a 2x return of capital at the end of the fund. So let me show you an example. On the right-hand side of the screen, I've got Samantha and Gary Smith. So they invested $108,000 in the fund. And in their first year as being partners, they took their 2 kids and another family over spring break to our 5-bedroom Big Island villa. The vacation value of that is approximately $7,000, of which they spent $650 visit fee for that trip. And then secondly, they did an extended family trip over 4th of July week to Park City and stayed in our 6-bedroom Deer Valley villa. That vacation valley similarly was around $7,000 for that week, that holiday week in Park City in the summer. And again, they spent about $650 on that visit fee. So for their $108,000 investment, in their first year as a limited partner, they received between $13,000 and $14,000 of vacation value for an out-of-pocket of $1,300 or $93 a night.
So not only did they get that great value, but they stayed at some amazing properties. The 2 properties in the example you'll see in the center here, the Big Island property on Hawaii, was actually recently featured on HGTV. And as John mentioned, it's a spectacular 5-bedroom home with sunset and ocean views, private pool, an amazing property. And then the second one you see down below, you see some of the views from the upper game loft, where you can see the mountains of Park City. It's just a few blocks from Main Street in Park City, right on Deer Valley Drive, easy to get up to the Deer Valley Resort. So these are both 2 amazing properties out of our portfolio of 10. And you'll see the portfolio is balanced between some East Coast locations, the newest of which is Marathon Key, Florida, and some West Coast locations, the newest of which is Kauai, Hawaii. Kauai is a property we actually just closed on that property officially last week, and it's a property we bought for roughly 52 cents on the dollar from the peak. And not only that, it's turnkey with high-end appliances, high-end finishes, high-end fixtures, which is fairly unusual for a short sale. And we were able to secure that, and that's actually going to be ready for use this July. In addition, though, we have Palm Springs, California, we have Maui, Hawaii, we have Mammoth Lakes, California, Longboat Key, Florida, Palm Beach Shores, Florida. So you can see the current portfolio of properties owned is at 10, but we're continuing to expand that portfolio, and we'll talk about some of those future locations later in the presentation. Here's just a few more views of that Big Island villa. Again, you can see the ocean views. You'd be able to see sunset out there, the pool. Even from the master bedroom there, it's indoor-outdoor living. You can see the waves crashing on the ocean from the balcony. So would love for everyone to be able to check out that property. And then the two newest ones, East Coast, Marathon Key, Florida. So this one is right on the water, has a boat dock, 4-bedroom property. It's actually currently getting ready for a remodel, so it'll be ready to use in time for the holidays. And then we have Kauai, Hawaii. Again, I mentioned this is a turnkey property. It's in the Princeville Resort on the north side of the island. Just beautiful, beautiful place, beautiful scenery, lots of beautiful beaches, golf courses. It's a spectacular location. Now, John mentioned we have two funds right now. So the first fund, the Equity Villa Fund, this fund was launched back in 2012. It already has over 70 investors and over 10 million in assets under management. And we're still accepting new investors for this fund, which will use those additional investment funds to acquire 4 or 5 new properties, and it'll be in places such as, the Mayan Riviera, the Bahamas, Los Cabos, Lake Tahoe, so places that are international but close to the U.S., where we can still find really good values and deals to allow us to buy those properties between 40 and 60 cents on the dollar. But we also have our newest fund, the Equity Platinum Fund, which is currently accepting reservations for founding limited partners. And if you're interested in that, we actually have a whole reservation process that allows you to get in on the founder offer, and you can reach out to us after this webinar and we'll give you more details on exactly how that works. But it's a unique opportunity to get in on the ground floor. We have some special incentives, and this fund, as John mentioned earlier, it's positioned a little bit more higher end. We're buying properties between $2 and $3 million, but a lot of the similar locations. So we'll have Hawaii properties, Florida properties, as well as some international locations. Now here's a few examples of some of the initial properties we're looking at for the Platinum Fund specifically. So again, keeping that balanced approach of having East Coast, West Coast, and mountain properties. We're looking at Bahamas, we're looking at Los Cabos, we're looking at Deer Valley. We're also have our eye on a couple alternatives in terms of Big Island and Hawaii in the resort areas, South Florida, and potentially Colorado. But we're kind of looking for that best deal, locking up those properties, and those initial founding folks with the reservations will become the founding members in the Platinum Fund. We also have a partnership with Elite Alliance. So Elite Alliance is a firm that allows access to 65 plus and growing additional locations around the world. And you can see a list of some of those locations here. But just to boil it down, basically how it works is we enable you to take your usage that you would have in the properties we own, convert those to credits with Elite Alliance, and you receive an account with Elite Alliance that has credits in it. Well, you can then use those credits to make reservations at any of these partner properties around the world. And the amount of credits required, it varies based on the property size, the time of year, etc. But it's generally a pretty good deal to make that exchange. John has an example where he went to the Bahamas just at the end of the off-peak season. I think it was late October, and his 1 credit to stay there. Well, he got 6 credits for exchanging his week. So he was able to kind of take that 1 week of use at one of our properties and convert it into multiple weeks at an Elite Alliance property. Now that may be different if you're trying to go someplace, say at Christmas, then it might be required more credits. I went to Esperanza down in Los Cabos, and it was an absolutely amazing property. It had a large 4-bedroom, 3,500 square foot villa with a private outdoor jacuzzi, private outdoor kitchen, access to all the resort facilities, the pool, the beaches, the restaurants, the concierge, and it was just an absolutely fabulous experience. So again, another benefit that comes with being part of our investment funds. So the next question that we get a lot is, how do we find the best deals in today's market? As I mentioned, we are still finding good values for our investors, as noted by the Kauai property. But the way we do it is we do a very data-driven approach. So we look at both the appreciation and cash flow potential of specific properties, And just to give you some examples, historically, we've gone through and plotted out values of homes by street and by block in areas that we're interested in targeting, so that when a good deal comes up in the area we're looking at, we already know what the right price is to pay, what we're willing to pay, what's below current market prices, and we can then act on that immediately without any delay and secure and lock up that opportunity. We also look at the rental yield that we can provide, and this is looking at year-round locations that enable us to drive rental income for most of the year. And that yield is what helps us then cover the operating costs. It helps us pay rental dividends when we do that. And so it's a critical component of selecting the right properties for our portfolio. We also develop a number of local market contacts to help us feed us opportunities when they become available. And these are folks that, and many times, are aware of things before they come on the market, might be aware of pending foreclosures, short sales that different buyers are working through, and sometimes we get a hold of these before they're even out on the market, giving us a leg up in terms of locking up the properties. So we're able to also move fast with all cash offers. When you're looking at properties that are distressed, estate sales, short sales, foreclosures, being able to come in with an all cash offer gives you a huge advantage. Many times we've even been able to purchase properties below what maybe someone else is offering for the property because we're coming in all cash. Also, we have experience negotiating short sales and foreclosures with lien holders. There's a lot of, I'll call it, games that the lien holders will play to try to drive up the price, get maximum value. And we've been pretty successful at calling their bluff and taking different negotiation approaches to lock in lower prices where other people might have been forced to pay more. Finally, we have a willingness and expertise to remodel and fix structural issues. So we've gone in to properties that have had different issues that needed to be dealt with, and we've very cost effectively gone in and added value to those properties. We do that selectively, and it's not our goal to necessarily go in and remodel properties, but when it makes sense and we can add a lot of value doing it, we will absolutely do that. And then finally, we're canvassing multiple markets simultaneously. So because of that, if I'm really focused, say, on Park City, Utah, but an outstanding deal comes up in Colorado for our Platinum Fund, I can quickly shift gears a little bit and say, okay, I'll just buy them in a different order. I'll buy Colorado first, I'll buy Utah second, because I know I can jump on that opportunity immediately and then circle back to Park City and find a good value there as well. So here's an example of our Big Island property, and this is the one that I mentioned was featured on HGTV. So if you watch HGTV's Building Hawaii, you'll actually be able to see the process, or part of the process, where this house was remodeled. But we bought this property for $211 a square foot. Now, $211 a square foot in Hawaii, you cannot build a property for. If you had the land given to you for free, if somebody put up all these rock walls and retaining walls and leveled the ground for you for free, you couldn't build the house for $211 a square foot. So we got it below construction costs. Why is that important? It means that there's a lot of upside, one, for our investors, but also, even if there was vacant land, nobody could go buy that vacant land and build and compete with us on price. We know we're going to be able to sell this property for more than what we paid for it. This property, we actually expanded it to a 5-bedroom property. It used to be 4-bedroom when we acquired it. We completely remodeled it. Kitchens, baths, outdoor kitchen, pool, everything's been redone on the property. It's better than new. The same exact property sold for $2 million in 2005. We paid $750,000 for it, invested $250,000 in the remodel. Our realtor estimates that this is worth $1.4 to $1.5 million today, and we expect that could easily double by the time we're ready to sell it 10 years from now. Being in Hawaii, we're also able to drive very good rental yields. We expect this to be a strong contributor to our portfolio in terms of covering our operating expenses and also providing amazing vacations to our partners. Here's an example from Florida. We bought this property in Palm Beach Shores. This one was $179 a square foot. It was a large, almost 45, well, about 4,300 square foot property. We actually extended that up to closer to 4,700 square feet by adding a media loft. We converted this from a 3-bedroom to a 6-bedroom. We relocated the kitchen, completely redid the kitchen, remodeled the bathrooms, just completely redid this home. It's 2 blocks from the beach. It's a block from the local marina. Just a great location, and we expect this property to be worth in the order of 1.3 to 1.5 million in terms of being able to sell it, which is significantly above our investment in it of just over $1 million. John?
Thanks, Greg. I'll jump in and talk about our other example acquisition, which was a pair of homes in Park City along Deer Valley Drive at the entrance to Deer Valley Resort. What we acquired was a luxury 5-bedroom, 6-bath, 5,500 square foot, and a 4-bedroom, 4-bath, 2,800 square foot house. We actually bought them out of foreclosure from a mortgage fund that had foreclosed on the developer. The properties actually didn't even have a certificate of occupancy, so we did our due diligence with the town, figured out what was necessary to actually complete the construction and actually get a certificate of occupancy. So this is hence why we were able to purchase, essentially over 8,000 square feet in Deer Valley for $1.8 million. We subsequently put another $400,000 to $500,000 into the properties to get the certificate of occupancy and really finish and fit them out as a ultra luxury pair of properties. This chart says the current market value is $3 million. That's very conservative. They're definitely worth more north of $3 million as a pair. Their peak market value was $5.9 million, and we would expect to get back to that value before the end of the fund. So, is there still value with respect to investing in the Villa Fund? And there really is. The property portfolio, we've already seen a 35% gain. The unit price that we're selling subscriptions at is $108,000 per unit, but the net asset value is $115,000 per unit and growing. A return to peak values could double your investment. So even though the subscription price has increased, today is an excellent time to invest because you're buying into a diversified portfolio of properties that were bought between 2012 and 2015. So it's a pretty unique opportunity to be able to still buy into properties bought in 2012 that are part of your portfolio, that at the end of the day, there's a slight price increase for buying in with a lower risk premium, but you're still going to be able to see that double in value before the end of the term. So from a high-level economics, we really believe that equity residences are the best value in our category, in this asset class, in this industry. For a 1-unit investment for $108 in the Villa Fund, you'll see 2 weeks of annual usage, which equate to $100,000 to $150,000 of net vacation value over the term, and then we're projecting a 2x return of capital on the back end. The Equity Platinum Fund has an initial buy-in of $265. You'll get 2 to 3 weeks of annual usage for that. And then with that, you'll get $200,000 to $250,000 net vacation value. And approximately, we're forecasting maybe a 1.5 times return of capital at the end. So as you can see, you're putting money that's actually working for you while you vacation. You're getting annual dividends of free vacations while your initial investment is actually increasing in value. So you not only get your money back, you get multiples of your money back at the end. So it's not just about the investment though. Greg and I truly believe we've created a unique opportunity for a phenomenal long-term real estate investment. And all of our LPs that have invested to date really do believe that they're making a very sound, smart real estate investment, and they've trusted us to put their money to work and know that they're going to have a return at the end. That said, on top of the great real estate investment, there's what we're calling the equity experience, in that you will go visit our properties and we're going to ensure there are quality linens, there's fine toiletries, there's beach and pool towels and chairs that when you show up at a property, there's an owner's closet. You know, Greg showed those great pictures of the Big Island property. Well, at the Big Island property, there's stand-up paddle boards there in the owner's closet for you to use. There's snorkel gear for you to use. There's plenty of beach chairs and towels and coolers on site. It's so when you show up, it's turnkey and everything's ready. At the same time, if you actually want to show up to the property and have a stocked fridge full of groceries and have someone meet you at the property and give you a tour and walk you through, and if you need local concierge to help you book restaurants and golf trips, all of that is available as well and will be kind of coordinated by Equity Residences, you know, kind of pre, during, and post your trip. Click on it. So now we've got an investor testimonial.
My name is Graham Pierce, based here in Newport Beach, California. Yeah, we like it for a few reasons. Number one, it allows options for family travel that we can bring not just family but friends as well. The properties are sizable enough to be able to do that. It's been a nice portfolio diversifier. Typical private equity investments that generally have lockups 3 to, in some cases, 10 years. It also allows you to enjoy that investment while it's locked up in the form of vacation time.
So what does all this mean for investors? Well, you heard the testimonial a little bit about how it's not only a great investment, but it's an opportunity to really enjoy with family and friends. To do that, there's a one-time upfront investment starting at $108,000. Now that $108,000, I don't think we talked about how that increases, but at $108,000, that's 2 weeks of guaranteed usage, but for only 50% more. So if you go up to $162,000, you're at 4 weeks of guaranteed usage, and $216,000, you're up at 6 weeks of guaranteed usage. So the usage really scales as you invest more. But for that usage, you also get a preferred return in the form of the vacation usage or the rental income. You get a long-term capital appreciation from holding a low-risk asset. And we say that's a low-risk asset because this fund doesn't carry a lot of debt. It's able to carry a little bit of debt, but our intention is during the utilization period that we're going to hold these properties debt-free, which is going to mean that we're never going to be in a position where we're squeezed to have to sell the properties. And if we don't have to sell, then the risk of us losing any money on the properties, you know, assuming we're properly insured, et cetera, as we are, is very low. Next, the property values have increased by over 35%, and the estimated current net asset value of the portfolio is $115,000 per unit. So there's a lot of upside in terms of investment upside. There's a lot of upside in terms of lifestyle and usage upside, and we believe the risk of the assets is relatively low. Now we're going to open it up for Q&A. We've already actually had a number of questions that have come in, and we'll start by taking one of the first ones that came in.
I got it. So everybody, please enter your questions in the panel on the right. There's a questions thing. Feel free to type in your questions, and Greg and I will address them one by one. The first question that came in are, what are the GP fees? So we set this up as a standard private equity fund that with 2 and 20 fees. So that's a 2% management fee annually, and then a 20% on the back end that's paid out of the profits of selling the real estate after 100% of the invested capital has been returned to investors.
And after the preferred return in terms of either the usage or the rental dividend.
Yes, correct. And then someone else was asking about that 2% management fee, and because that management fee is paid out of the rental income, so it's not a tax per se on the LPs annually, in that our property management entity is ensuring that we're creating enough rental income to cover the property operating expenses as well as the fund operating expenses, so that 2% will be covered by excess rental income that we're driving through the portfolio.
So question, if you buy at the entry point, are you able to take more than 2 weeks vacation, and at what price? So the answer is yes, and there's a couple ways you can do that. One is all of our investors have access to unlimited space available. And so the space available windows for properties vary based on the location, if it's a drive to or a fly to location. But the way space available works is if the property hasn't already been taken by another partner and hasn't been rented, you can raise your hand within that window and say that you would like to go use that property, and that will not count against your allocated annual usage. The only cost to doing that is paying the visit fee, and the visit fee averages about $450, but ranges between $250 and $650 depending on the property.
So another question came with respect to, we said we had 70 shareholders, and what equity does that represent in dollars? So, I mean, the actual figures are 67 limited partners for 94.5 units at 9.2 million in equity raised to date. And of that 9.2 million has all been put to work in real estate. And, you know, frankly, the real estate portfolio now is actually worth probably around $12 million of total real estate. But we're happy to share more details with individuals on a personal basis after the call.
So we just got a follow-up question on the visit fee, if that's per visit or per night, and that's per visit. So the visit fee, if it's 3 nights or less, is actually slightly lower than the numbers I quoted. The numbers I quoted are for visits of 4 nights or more, but it is per visit, not per night.
Somebody asked about special incentives for the Platinum Fund.
So for Platinum Fund investors, we have an opportunity for you to get discounted pricing and other incentives, and I'd suggest that you reach out to us, and we're happy to go through those and have you learn more about that on an individual basis. But absolutely, there are some incentives out there for our founding partners. So we also had a question about, about the rental charge of, is there money taken off of rental income? They're saying most rental companies charge 40 to 50% of rental income, and that's true. A lot of companies do that. And so if you were a personal owner of a vacation property and you went out and tried to buy a property and then have a local company rent it for you, they're going to take a very high percentage of that income, and it makes it very hard for you to make the property cash flow. We have an in-house property management company, and they manage these properties directly for us. And by doing that, not only do we not pay that 40 to 50% fee, but we're also, frankly, much, much more effective at managing the properties, driving the utilization and the rental income than most of these local agencies. We've purchased properties, and if you look at the rental performance prior to us acquiring the property versus after, we're driving significantly higher revenue, and that's in spite of the partners using the properties as well.
So there's a couple questions about our liquidation period and how the disbursement phase works. So we say it's a 10-year fixed fund. However, we created that 10-year liquidation period to ensure we catch the next market peak. And so we fully expect to harvest the portfolio and ensure that we maximize the returns to investors over that 10-year window. So we will likely start selling properties in 6 years, 7 years, when we can capture significant return, and it will be market by market and property by property. We'll very likely be selling the California and Florida properties before we're selling, the Mexico properties that we own. But again, it's going to be market by market, and the GP has some discretion to ensure that we maximize returns. And then, piggybacking onto that, someone asked is what happens if we liquidate the fund and the market's in a downturn? Well, that's exactly why the GP has some discretion to liquidate early, because we're going to make sure that if there is a market peak in 7 years from now, that we don't just hold on to the properties to year 10 just to get incremental usage out of them. We'll ensure that there are returns maximized. Now, that said, if at the end of the period we're holding on to real estate and we are in a market downturn, there's also some discretion on the back end where the GP can hold the properties for 4 6-month periods, so for another 2 years, again, to kind of maximize that return on the back end. And then after that window, there really is no leeway for us, and it would actually be up to the limited partners as to how to liquidate the fund.
So we had a question about can you receive a copy of our private placement memorandum, and absolutely. So feel free to reach out to us directly after this webinar, either myself or John, and we'll be happy to get one of those out to you. If you have a preference for one of the two funds, the Platinum Fund, which is the higher end fund with $2 to $3 million properties, or the Villa Fund, please let us know which one, and we'll be happy to follow up.
So there's a couple follow-ups to that last question I was answering. And if we're selling properties early, someone asks, is their investment still returned to them in 10 years? The answer is no. There'd be no reason for the fund to hold on to capital. So as we liquidate properties and we create capital, we would start dispersing those to the LP. So if you're really thinking about this from an IRR perspective, you will see some of your investment back before the 10-year period as we sell properties. Now, as we create that cash, that 100% of it is going to go to the LP. So the GP is not going to get any of their 20% carry on any individual property. We've got to actually do 100% of the entire investment back to investors. So our incentive is to get cash back to investors and not hold on to those in reserves at an early period. Similarly, someone asked then, if we liquidate some properties early, does that change their vacation time that they would have allotted over the 10-year period? And it very well, during the last few years of that utilization window, adjustments might have to be made with respect to overall usage as we liquidate the portfolio. And as a partnership, we would agree to ensure that it's fair and equitable, and at the end of the day, that enough usage is available for the partners and the commitment that we've made. But again, first and foremost, it's ensuring that it is a sound investment, and that when we start liquidating the properties, we're doing that in the best interest of all LPs.
So there's a question about what percentage of equity is owned by limited partners. Does it vary by property? The answer is that as a limited partner, the limited partnership itself owns all the property, and then you own a portion of that limited partnership based on how many units you invest in. And what your percentage of that limited partnership is will depend on where we are at final close. But you can do the rough math. If we have just right around 70 partners today, right around 90 some units outstanding. So if you buy one unit, then you'll just have that proportional fraction of it, and that fraction will be based on where we end up at final close.
A question came in from Jonathan about, on average, how many weeks of the year have you managed to rent it out? So there's not a straight answer to that, because we're building a world-class property management entity inside Equity Residences, to where we're learning that as we launch a property, it takes a year to really reach kind of the point with respect to maximizing rental. And then in year 2, we start really creating year-over-year improvement using our tools. Now, I'll give you an example. The Maui property, now we've owned it for 3 years. And over the last 12 months, we're now actually approaching a 90% occupancy rate at the Maui property. And of that, about 35% of that is our partner use, and then 55% of that was rental use. So it's a really good mix that's driving income. Now, that Maui property requires, it's about 30 to 35% rental yield to cash flow Maui. And so at the 55%, Maui is more than paying for itself and contributing excess cash for the rest of the portfolio.
Now, just because the property is running at 90%, I don't want to think people to think you can't access that property. That property, the way we set up our reservation process, and we didn't talk a lot about this, but our reservation process starts in April for the upcoming reservation year that begins October 1st. And so that allows you to go in and select and book the weeks. So you might want to book your kids' spring break, etc., prior to all those weeks being taken for rentals. And then we go in and we fill in weeks with rentals to drive that income that covers the operating dividends, covers the operating expenses, and covers the rental dividends. But it doesn't, just because we're running at that high of occupancy, doesn't mean you can't use it. And we also have people that have picked up that property on a space available basis. In fact, I think we had someone in there for space available just last week.
Yeah, we did. Somebody asked, how liquid is my investment? And I'm able to sell it before the equity matures. So that's a good question. We get that a lot. The answer is Since it is a limited partnership, it's a relatively illiquid investment. However, there are very few sale and transfer limitations that we have put within the limited partnership agreement. So you are able to sell your shares, you're able to transfer your shares. The only kind of limitation was that the partnership does have a right of first refusal to buy those shares if you do find your own limited partner to replace you. But other than that, if you raise your hand, the GP will even help you sell those shares. Equity Residences is going to be in this category for quite some time. You know, we've launched our fund 2. We'll be launching funds 3, 4, and 5, you know, in the future. So we will always be marketing real estate investments to potential LPs. And so we do have a provision to even help you liquidate your interest if for financial or personal reasons you need to do that.
So there's a question about who gets the proceeds from renting outside the limited partnership. So the proceeds from the rental income go to the limited partnership. There's no, in general, there's no cut taken by anybody else. The revenue comes straight in to the limited partnership. And then those proceeds are used to cover different expenses, whether it's property taxes for the fund, the management fees, etc. If you elect a rental dividend, then those proceeds are also used towards your rental dividend. And then if there were any excess cash beyond that, that is just held by the limited partnership. But the way the fund is really set up, it's set up and designed so that the proceeds are used for rental dividends and they're used for operating expenses.
So Mike asked how many weeks are owned by the present time by the 67 shareholders and how many properties. So the model is built around 40 to 45% of our occupancy is what goes to LPs for their buy-in. So that's how the model works. We're kind of expecting 40 to 45% of usage for our partners. So of that 67, shareholders, if you will, they don't own specific weeks at any property, right? So that they have the right to use up to 7 nights, what we call a property visit. So, if you ask for the offering memorandum, you'll be able to see all the verbiage and how that works. But for those, call it 67 investors, that equates to about 200 weeks across the portfolio. And in that 10 properties, there's about, there's 520 weeks available. So that's about 40% of the available weeks that have been allocated to partners. Now, I'm going to ask my own follow-up question to that I get a lot from folks that are saying, hey, if 40% of your weeks are allocated, do I get the weeks I want? So if I'm making this investment to go on spring break with my kids, am I going to be able to do that? I can confidently say yes. We just finished a reservation window, and yes, kids spring break actually was the most coveted week, but since we're a bi-coastal fund, spring breaks are different. And since we have 3 Florida properties and 3 Hawaii properties, there are plenty of beach destinations for our partners. So all the partners that actually wanted a spring break week got it. Now, one reason for that is even though we have 40% of the available weeks allocated to partners, remember you have an option of what you want to do with those weeks. So you can stay at one of our properties, or you can opt to take Elite Alliance credits and go stay across a network of their properties. Or as a third option, you can convert those weeks into what we call a capital dividend, which is your share of the residual rental income. And honestly, there's another option, which is a do-nothing option, which some of our partners just sit and hold their weeks, and they just wait, and they kind of use them during the year as a first-come, first-serve throughout the year. So given that, only 15 to 20% of our available weeks are typically taken during the annual reservation window. So the fact that we have all these partners only vying for 15% of the calendar creates that opportunity for folks to really take the trips that they want.
So there's a question here about how many properties are acquired per year, or how many do we envision acquiring per year. The answer is, for the Villa Fund specifically, it's scaled up each year. I would anticipate us acquiring another 4 to 5 properties over the next year as that fund closes out. The Platinum Fund, on average, I'd expect that to acquire about 5 properties per year, maybe slightly less early on and slightly more later in the fund. We are out of time now, though. We do have a lot more questions coming in, and so what I'd like to do is please reach out to John or myself directly. We're happy to answer any questions, have a discussion, and we can give you a lot more details in terms of how both the Villa Fund and Platinum Fund work. But thank you, everybody, for your time today.
Yeah, thanks, everybody. Please feel free to follow up with Greg or I. Thanks.